Let's get back to the tax story that we are tracking. Singapore-based residents will have to pay capital gains tax in India from the next financial year. This is keeping in line with similar amendments made to the India-Mauritius Treaty. Dinesh Kanabar, a tax veteran, CEO of Dhruva Advisors, is here with us to take us through the implications of this. Mr. Kanabar, thanks very much for this.
Thank you.
Very simply for our viewers, sir, what does this really mean?
So it was about 4 months back that the government came back to say how they would change the India-Mauritius Treaty. And they came back to say that India will enforce source-based taxation in respect of capital gains arising to residents of Mauritius, as opposed to a total capital gains tax exemption. There was a 2-year transition provision, etc. And thereafter, it gets taxed fully. I think one of the key things which happened in the Mauritius Treaty amendment, which was very, very welcome by the foreign investors, was the fact that there was a grandfathering, meaning thereby that for all investments that have been made till 31st March 17, whenever those investments are unwound, and that could happen a decade later, 2 decades later, the capital gains tax exemption would be available. The transition provisions really were not of much implication because they applied only to a situation of investments and divestments within that 2-year period, which would be a very short window really. And thereafter the tax would apply. So there was a sufficient notice. There was a limitation of benefit which was introduced. And therefore people were very, very satisfied with the entire situation. And then the question was, would that as it is without any amendment apply to the India-Singapore Treaty, or would the India-Singapore Treaty need to be renegotiated? And clearly, while the Singapore Treaty itself postulates that the capital gains tax exemption applies only till the Mauritius exemption applies, the question of grandfathering, the transition
Those
provisions
questions were up in the air. Those are absolutely clear now.
Correct.
Right?
And it appears that the government is now reaching some sort of a negotiation with Singapore. I'm very sure that, like in the case of Mauritius, Singapore will seek grandfathering. That's something which is fundamental. Will want to ensure. There was one thing which I heard earlier today when I was talking to Sapna on your channel, where she mentioned something which really made me feel very good, which was that the government seems to be veering towards a view that the general anti-avoidance regulations, GAR, will not apply where you comply with limitation of benefits under the treaty.
In 30 seconds, what does limitation of benefit mean?
So limitation of benefit basically is a provision within the tax treaty which says that if you comply with certain conditions, you will be deemed to be a resident and the benefits of the treaty will be available.
Okay.
So if that applies...
So what you're saying is even after GAR comes into effect, in situations where the treaty provides some exemption,
correct,
GAR cannot be applied.
That's right.
And those people or those transactions cannot be taxed. GAR will not override everything.
Correct.
It will be
so
selective.
Very simply, there is a proposition that where there are specific anti-avoidance regulation, so limitation of benefit is a specific anti-avoidance regulation. So where specific applies, general ought not to apply. That's the proposition. And if the proposition was that GAR would apply, investors would really be worried because there is a subjectivity and then you have to meet 2 thresholds, which really ought not to be the case.
Absolutely.
Well, Mr. Kanabar, if I can also come in on that note then, with the government now trying to renegotiate its tax treaty with Singapore, what do you think are the 2 or 3 key issues that investors would be keeping a close eye on? You said that you expect this, the changes to be pretty much similar to the changes that India made as far as its tax treaty with Mauritius is concerned. But is there some fear that, that as far as issues of grandfathering is concerned, as far as issues of sort of protecting investments that were made prior to April 1, 2017 is concerned, as far as these issues go, do you feel that that largely the changes with respect that India will be making with the Singapore government will be the same as the one that they've already done with Mauritius?
Let me answer this a little bit holistically. There are 3 tax treaties which have been a subject matter of controversy and abuse. One is the Mauritius Treaty, the second is the Singapore Treaty, and third is the Cyprus Treaty. And it is indeed commendable that the government has renegotiated all 3 of them. With regard to Cyprus, there was a blacklisting and therefore a question of a higher withholding tax inconsistent with the provisions of the tax treaty. The government has now renegotiated the tax treaty, and once that is notified, the higher withholding will go away and the past higher withholding will get refunded. A very welcome provision. You look at what has happened between Singapore and Mauritius, and while of course the provisions of the amendment between India-Singapore Treaty are still not in the public domain, for a moment assuming that it is in the public domain, what we are saying really is all investments till 31st March 17 get grandfathered. GAR does not apply, and I hope that is the situation really, because that is something which is uncertain in my mind. Earlier, there were public pronouncements which were made by revenue officials that GAR would apply even where limitation of benefit has been complied with, and I hope that is not the situation. But now investors exactly know the position pretty much in advance. When they know that there is no uncertainty, and when there is no uncertainty, they compute their IRR on the basis of net of tax. And indeed, we have a very low tax regime. If you are trading on the stock exchange, there is zero tax. So really, you are dealing with
actually, investors, whoever we've spoken to, have always maintained since this entire controversy began, 4 or 5 years back, right? That tell us what the rules are.
That's it.
I mean, we'll pay the tax, but tell us what the rules are.
And the taxes themselves are pretty modest. They compare with the best regime in the world. Why would one not? So if you are paying a 10% tax, you're looking at a 10% higher IRR in an economy which is thriving and which is where all investors are looking at.
I think this works well now because the rest of the world, in terms of growth, is looking so down and out. Right?
Absolutely.
So people, I think,
let me make another proposition to you. India is not a banana republic where you can blatantly abuse treaties. For any investor to have expected that the holiday coming from Mauritius is going to be perennial is a myth. It can't happen. It has not happened anywhere in the world. So that window had to shut. But the way the government has shut the window is really a well
responsible and well thought through.
Absolutely.
Just in terms of flows, how much comes from Singapore, and we've discussed this in the past as well. How has that changed now?
Singapore Mauritius at one point of time was close to 60, 60 went down to 46, and now it is sub 25.
These are what percentages?
Percentages.
This is FII investment. Portfolio flows.
That's right. That's right.
Ron?
Well, Mr. Kanaba, one final question from my side. Many people are wondering now that with the government renegotiating its tax treaty with Singapore, having already renegotiated one with Mauritius, it could be advantage Netherlands as far as these sort of tax treaties are concerned. Would you concur with that view?
The officials of the government are on record publicly stating that they have asked for a renegotiation of the tax treaty with Netherlands. If and when that happens, one remains to see. However, as of today, assuming for a moment that the India-Dutch treaty is not renegotiated, it certainly will be very, very advantageous. It offers a blanket exemption under certain set of circumstances, and in certain other circumstances, taxes only transfers between residents and non-residents, and no taxation on transfer between two non-resident. So yes, indeed, a very, very welcome treaty. I might just make one point here. The India-Mauritius treaty renegotiation incidentally provided one very big advantage to Mauritius, and that is with regard to debt inflows. So the withholding tax under India-Mauritius treaty today on debt is 7.5%, which is the lowest amongst all the treaties that India has signed with anybody else.
Well, that's a very interesting point to end this conversation with. Thank you very much, Mr. Kanabal, for joining us and taking us through the implication of that.